Are you aware that a U.S. apartment giant is making a significant move into the Canadian real estate market? This could have major implications for multifamily investments in Canada. Welcome to the Multifamily Real Estate Insights podcast. I'm your host, Sandy MacKay. Let's get right to it. In a noteworthy development in the multifamily real estate sector, Morgan Properties, which is based just outside Philadelphia, has announced its agreement to acquire Dream Residential Real Estate Investment Trust. This Toronto-based trust is valued at approximately $354 million United States dollars in an all-cash purchase offer. This acquisition marks the culmination of Dream Residential's strategic review and would require stakeholder approval before closing later this year. Dream Residential REIT is headquartered at 30 Adelaide East in downtown Toronto and boasts a portfolio of 15 properties, totaling approximately 3,300 units. These are predominantly garden-style apartment properties located in regions such as the metropolitan Dallas-Fort Worth area, as well as in greater Oklahoma City and Cincinnati. The REIT, which began operations 3 years ago, has been under the leadership of CEO Brian Pauls since June 2023. Morgan Properties, already ranked as the third largest apartment owner in the United States by the National Multifamily Housing Council's 2025 top owners list, sees this acquisition as a strategic expansion. The firm, which claims a portfolio of over 100,000 units across more than 360 municipalities in 22 states, aims to strengthen its presence in the Midwest and capitalize on rent growth in high-demand areas like Texas. With this acquisition, Morgan Properties will extend its reach beyond its established markets in New York and Pennsylvania. This transaction will also conclude Dream Residential service agreements with Dream Unlimited and Pauls Corporation, with a separation payment of $7 million United States dollars to cover outstanding fees and wind-down costs. Jonathan and Jason Morgan, co-presidents of Morgan Properties, continue to build on the legacy of their father, Mitchell Morgan, who founded the company in 1985. The firm is headquartered in Conshohocken, Pennsylvania, with an additional office in Rochester, New York. The Canadian multifamily market is currently navigating some choppy waters. According to a recent report from Oxford Economics, the combination of new supply flooding the market and escalating trade tensions with the United States is putting downward pressure on the housing sector. The national average asking rent in Canada fell to $2,129 per month in May, a decline of 3.3% from the previous year. This trend is especially pronounced in cities like Calgary, Vancouver, and Toronto, which have seen some of the most significant drops in apartment rents over the past year. Adding to the complexity, the completion of new multifamily units surged by 35% in 2024, swiftly increasing the housing stock. Oxford Economics anticipates that this strong growth in rental supply will persist, as record numbers of purpose-built rental units are finalized and absorbed into the market. However, the demand side is softening, with slower immigration and fewer temporary residents curbing rental needs. Despite these challenges, there's a silver lining. The report suggests that worsening homeownership affordability and the financial strain on households exacerbated by a trade war-induced recession may sustain rental demand in the coming quarters. As homeownership becomes less accessible, many Canadians might continue to rely on rental accommodations, which could help stabilize the multifamily market in the longer term. On the international stage, the trade dispute between Canada and the United States is adding another layer of uncertainty. The situation escalated when U.S. President Donald Trump threatened to intensify the trade war over tariffs unless Canada rescinded its digital service tax targeting American tech giants. In response, Canadian Prime Minister Mark Carney's government agreed to resume negotiations, aiming to reach a deal by July 21st. However, the outcome remains uncertain, and the tariffs could continue to create headwinds for the Canadian commercial real estate industry. Tony Stillo, Director of Canadian Economics at Oxford Economics, has expressed concern that unless a resolution is reached to remove most U.S.-Canada tariffs, the housing slump could extend through the end of 2025. He anticipates that the resale housing market recovery may stall due to poor affordability, weakened consumer confidence, and job losses from the recession. Additionally, a shrinking population from immigration cuts could further weigh on the sector. CoStar Market Analytics has noted some rebalancing in the multifamily market. According to their report, market vacancy rates are approaching more balanced levels in extremely unaffordable urban markets like Toronto and Vancouver, while Alberta sees vacancy rates moving towards cyclical highs. This rebalancing might offer some relief to property owners and investors, providing opportunities to adjust strategies and seize potential gains in a shifting market. Now, let's delve into the Canada real estate market outlook for 2025, as reported by CBRE. Canada stands at a crossroads on various fronts, including political, economic, and social issues, such as housing affordability and congestion. Despite these challenges, the country remains a growth opportunity. It ranks among the top G7 nations in GDP, population, and employment growth over the next 5 years, which are all highly correlated with demand for all types of commercial real estate. Looking ahead to 2025, the real estate market in Canada is expected to see increased activity. The easing of the capital cost crisis, contingent on global bond market conditions, will likely lead to a boost in investment and leasing activities. While leasing fundamentals are improving overall, significant new supply in the office, industrial, and residential sectors will take some time to work through. However, this is an exciting period for investors and tenants alike, as opportunities are on the horizon. In terms of economic performance, despite slightly lower growth forecasts due to immigration restrictions, Canada's long-term outlook remains robust compared to other G7 countries. This bodes well for commercial real estate demand, particularly in the multifamily sector, where long-term growth fundamentals present a compelling investment thesis. The capital markets are showing positive signs, with expectations of stronger investment activity in 2025. More capital is anticipated to come off the sidelines, and cap rates for some asset classes may start to compress, depending on global bond market conditions. This could present unique opportunities for multifamily investors. On the debt markets front, availability is predicted to improve, although lenders will remain selective. Credit spread dynamics are expected to normalize, and loan underwriting will reflect broader market trends concerning rents and vacancy rates. This is a crucial aspect for anyone looking to invest in multifamily properties. The multifamily sector, despite uncertainties from immigration curbs and new supply, continues to show solid long-term growth fundamentals. Investors should keep an eye on this sector, as it remains an attractive proposition for those looking to capitalize on Canada's economic resilience and demographic trends. In summary, Canada's real estate market in 2025 is poised for increased activity and presents numerous opportunities for investors, especially in the multifamily sector. As always, staying informed and adaptable will be key to navigating this ever-evolving landscape. Thank you for listening to the Multifamily Real Estate Insights podcast. I'm your host, Sandy MacKay. See you on the next one.